Something feels off about 2026. And I don't mean that in some vague, doom and gloom, the sky is falling kind of way. I mean something specific. Something that almost nobody is talking about because it doesn't fit neatly into the bull versus bear narrative that dominates every financial headline. My name is Tom, and I spend way too much time analyzing markets, reading earnings reports, and trying to figure out where everything is headed next. If you're someone who's been watching the market lately and feeling confused, conflicted, or like you're being pulled in two completely different directions by the financial media, hit that subscribe button and give this video a thumbs up because today we're going to cut through the noise and talk about what I actually think is happening. Here's the uncomfortable truth that both bulls and bears don't want to hear. The most dangerous market environment in 2026 isn't going to be a crash, and it's not going to be a melt-up. It's going to be something far more insidious, something that destroys portfolios, slowly, quietly, without the dramatic headlines that would at least give you the satisfaction of knowing what went wrong. But before I get to that, let me lay out what both sides are actually arguing, because there are legitimate points being made on both ends of the spectrum. And understanding those arguments is crucial before we can see what they're both missing. Let's start with the bear case, because whether you think AI is going to reshape the global economy or that it's the most overhyped technology since anyone can remember, one thing is undeniably clear. We may have gotten ahead of ourselves with the AI story. The numbers don't lie. NVIDIA is trading at around 47 times earnings. Palantir sits at roughly 400 times earnings. And Datadog? Try over 430 times earnings. At these valuations, you're not investing based on fundamentals anymore. You're essentially pre-ordering hope. And here's the problem that should concern every investor, regardless of where they stand on the AI debate. These stocks aren't just inflating their own valuations. They're dragging the entire market up with them. When NVIDIA goes up, it pulls semiconductors higher, which pulls the tech sector higher, which pulls the S&P 500 higher. And suddenly you look around and realize the S&P is trading at nearly 31 times earnings, which is almost double the long-term historical average of around 16. If these trading multiples normalize back toward historical averages, it's not just AI stocks that take a hit, it's the whole market. And we haven't even talked about the concentration problem yet. The S&P 500 is supposed to represent broad diversification across American business. That's the whole point of owning an index fund, right? You're getting exposure to 500 different companies across multiple sectors and industries. Except that's not really what's happening anymore. The Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, and Tesla now represent over 35% of the entire S&P 500's total market capitalization. That's more than a third of the index concentrated in just 7 companies. Through the first 3 quarters of 2025, these 7 stocks accounted for over 41% of the S&P's total returns. If you swap out Tesla for Broadcom, that contribution increases to over 55%. Think about what that means. The index that most people own through their 401ks and retirement accounts, the index that's supposed to give them diversification and protection from single stock risk, is quietly turning into a very concentrated bet on a handful of tech giants. It's like a group project where 2 people do all the work and everyone else still gets the credit. Except in this case, when those 2 people stumble, everyone fails together. The explosion in passive investing has only made this worse. Most index funds and ETFs that track major benchmarks are market cap weighted, which means a stock's influence in the index is directly proportional to the size of that company. The bigger the company, the more weight it receives, and the more it affects how the whole index performs. As these tech stocks have grown larger, they've naturally taken up a larger share of the index. And when new capital flows into these funds, it disproportionately gets allocated to those same tech names. It's a feedback loop that's beautiful right up until it isn't. Because when indices become this top-heavy, small moves in a handful of stocks can create big problems for everyone. A 10% pullback in NVIDIA doesn't stay isolated in NVIDIA. It bleeds into the Nasdaq, then the S&P 500, then creates broader market pressure, and suddenly, what you thought was a diversified portfolio is reacting to the mood swings of a handful of stocks. Here's one more piece of data the bears like to point out. Statistically speaking, we're overdue for a down year. Since 1954, the S&P 500 has averaged a pullback of at least 10% about once every 3 years. After several years of outsized returns, history tends to suggest we need to pump the brakes. Corrections aren't anomalies. They're actually normal and healthy. But timing them is essentially impossible, which brings us to the uncomfortable reality of the bear case. You can be right on valuations. You can be right about unhealthy concentrations in indices. You can be right that we're overdue for a pullback, and you can still be wrong. Because being right too early is indistinguishable from being wrong. As the famous economist John Maynard Keynes once said, markets can remain irrational longer than you can remain solvent, and that's the trap. The bears have legitimate concerns, but acting on those concerns prematurely has destroyed more portfolios than the crashes they were trying to avoid. So now let's flip to the bull case, because there are legitimate tailwinds that support higher prices too. Whether you trust the Fed or you think Jerome Powell runs monetary policy decisions through a magic 8-ball, one thing is clear: interest rates are coming down. 2025 ended with the Fed delivering 3 consecutive 25 basis point cuts, and going into 2026, the median expectation is at least one additional cut. Lower rates mean cheaper capital. Cheaper capital means higher valuations. Higher valuations mean investors are more comfortable paying premiums for future earnings. That's why rate cuts don't just matter to borrowers, they matter to stock prices too. When liquidity loosens and financial conditions ease, risk assets tend to rise. That's just how the relationship works. And right now, that relationship is working in favor of higher prices. But the monetary policy backdrop is only half the story. The other half is fiscal policy. While the Federal Reserve argues over quarter-point cuts, the U.S. government is doing something far more impactful: spending. The United States now runs a deficit of more than $1 trillion annually. Now, I've talked on this channel before about why the deficit is becoming a serious long-term problem and the damage it could cause down the road. But in the short term, government spending does bring some benefits. It puts money directly into the system. It supports consumer demand. It props up corporate revenues. It keeps economic activity elevated, even when the private sector might otherwise slow down. And unlike monetary policy, fiscal policy is slow to change. Programs don't get shut down overnight. Budgets don't suddenly get slashed. Politicians don't win elections by campaigning on frugality. So even if growth cools, the fiscal backdrop remains supportive in the near term. And that matters for markets. So there you have it. The bear case has real substance. Stretched valuations, dangerous concentration in a handful of stocks, historical patterns suggesting a pullback is overdue. The bull case also has real substance: rate cuts, fiscal support, and a macro backdrop that continues to favor risk assets. Both sides have smart people making compelling arguments. And if you've been listening to financial media lately, you've probably felt whipsawed between these two narratives, never quite sure which one to believe. But here's what neither side is talking about. Here's the scenario I almost never see discussed, and it's the one that concerns me far more than either a crash or a rally. What if neither happens? What if the market doesn't melt up and it doesn't crash? What if we get something in between? The kind of market where headlines flip every 2 weeks, where rallies stall just as confidence builds, where dips feel scary without ever providing real buying opportunities, where your account balance seems to go nowhere for months at a time. I'm talking about a long, choppy, sideways market. And these markets are often the hardest to survive. See, crashes are painful, but they're at least clear. You know what's happening. You know the playbook. Stay calm. Keep investing. Wait for the recovery. Bear markets have an end date, even if you don't know exactly when it is. The strategy is simple. even if the execution is emotionally difficult. Melt-ups are the opposite kind of clear. Everything is going up. You feel smart. The strategy is to stay invested and enjoy the ride. But sideways markets, they're a different beast entirely. Nothing feels right. Every decision seems wrong in hindsight. You buy and it drops. You sell and it rallies. You hold and it goes nowhere, while inflation eats away at your purchasing power. The financial media keeps publishing contradictory headlines because there's no clear trend to report on. Bulls get frustrated because their thesis isn't playing out. Bears get frustrated because the crash they predicted never comes. And regular investors get exhausted. This is the environment where impatience destroys portfolios. Not dramatic crashes, not bubbles popping. Just slow, grinding, inconclusive price action that tests your resolve month after month until you do something stupid out of frustration. Consider someone who had $200,000 invested at the start of a sideways market period. After watching their balance fluctuate between $185,000 and $215,000 for 18 months with no clear direction, they got tired of the uncertainty. They shifted to cash, planning to get back in when things cleared up. But things never clear up in a way that feels safe. By the time they were comfortable investing again, they'd missed a 15% rally that happened in 2 months. That delay cost them over $30,000 in potential gains. Not because they were wrong about valuations or wrong about the risks. They were just worn down by the uncertainty and made an emotional decision at exactly the wrong time. This is the gray area between bull and bear markets that's so dangerous. And it's the scenario I think is most likely for at least part of 2026. Not because I'm certain about it, nobody can predict markets with certainty, but because when fundamental tailwinds collide with real structural risks, markets rarely move in clean, predictable ways. So what do you actually do with this information? How do you position yourself for a market that might not give you clear signals in either direction? The first thing is to accept uncertainty as a feature, not a bug. Most people want clarity. They want someone to tell them the market is definitely going up or definitely going down so they can position accordingly. But that certainty almost never exists in real time. It only exists in hindsight, when we can look back and connect dots that weren't visible when we were living through it. The investors who do well over decades aren't the ones who correctly predict every market move. They're the ones who build systems that work across multiple scenarios. They're the ones who don't need to be right about what happens next because their approach is robust enough to handle different outcomes. For most people, that means continuing to invest consistently regardless of market conditions. It means maintaining an asset allocation that you can actually stick with when things get uncomfortable. It means not making dramatic changes based on what the market might do in the next 6 months because nobody actually knows what the market will do in the next 6 months. The second thing is to be honest about your own psychology. Sideways markets are psychological warfare. They test your patience, your conviction, and your ability to stick with a plan when nothing seems to be working. If you know you're the kind of person who gets antsy when your account balance doesn't move for months, plan for that. Maybe that means checking your portfolio less frequently. Maybe it means having a trusted friend or advisor you can talk to when you're tempted to do something impulsive. Maybe it means writing down your investment plan and the reasons behind it so you can refer back to it when emotions are running high. The people who get hurt in sideways markets aren't the ones who were wrong about valuations or wrong about the economy. They're the ones who couldn't handle the uncertainty and made reactive decisions that locked in losses or missed gains. Knowing yourself well enough to plan around your own weaknesses is one of the most underrated skills in investing. The third thing is to remember why you're investing in the first place. If your goal is to build wealth over 10, 20, or 30 years, then what happens in 2026 is honestly just noise. It's a single year in a multi-decade journey. The compounding that creates real wealth happens over time horizons that make any single year essentially irrelevant. I know that sounds dismissive when you're actually living through the uncertainty, but it's also true. If you zoom out far enough, every market environment crashes, melt-ups, sideways grinds, eventually gets absorbed into a long-term upward trend. The S&P 500 has returned roughly 10% annually over the past century, despite wars, recessions, panics, bubbles, and every kind of market you can imagine. It did that not because every year was good, but because enough years were good that the compounding eventually overwhelmed the bad years. Your job isn't to optimize for 2026. Your job is to stay in the game long enough for compounding to do its work. Now, I want to be clear about something. I'm not telling you to ignore what's happening in markets. I'm not saying valuations don't matter, or that concentration risks aren't real. Those things matter, and being aware of them makes you a better investor. What I'm saying is that awareness and action are two different things. You can be aware that the market is expensive without selling everything. You can be aware that concentration in mega-cap tech is a risk without abandoning index funds. You can be aware that a sideways market might test your patience without making preemptive moves that could backfire. The best investors I know hold complexity in their heads without letting it paralyze them. They understand the bull case and the bear case and the cases in between. And then they execute a reasonable plan consistently, adjusting around the edges when necessary, but never making dramatic changes based on predictions about what might happen next. That's the real skill here. Not predicting markets, not timing the perfect entry or exit, just showing up, month after month, year after year, with a plan that's robust enough to survive whatever comes next. So where does that leave us for 2026? Here's my honest assessment. I don't know what's going to happen. Nobody does. The bulls have legitimate arguments. The bears have legitimate arguments. And the most likely scenario might be something in between that frustrates everyone. What I do know is that the investors who will come out of this year in the best shape aren't the ones who correctly predicted whether the market would be up or down. They're the ones who had a plan, stuck with it through the uncertainty, and didn't let short-term noise derail their long-term goals. The market has a funny way of rewarding patience and punishing impatience. It rewards people who can sit quietly while everyone else is running around trying to guess what happens next. It punishes people who need the market to do what they expect in order for their strategy to work. That's the uncomfortable truth about 2026. The most dangerous outcome isn't a crash that at least gives you clarity. It's not a melt-up that makes everyone feel like a genius. It's a long, grinding, inconclusive market that tests whether you actually believe in your own investment philosophy. Now, I want to hear from you. I'd love to know where you land on all of this. Do you think 2026 is the year things finally break? Do you think we rally higher and make new all-time highs? Or do you think we're headed into that uncomfortable gray area that nobody seems to be talking about? Drop your take in the comments because I'm genuinely curious to see how divided everyone is on this. And here's what I want you to think about. What's your actual plan if the market goes sideways for the next 18 months? Not what you think you'd do. What's your written down, committed to plan? Because if you don't have one, now might be a good time to think about it. If this video helped you see 2026 a little differently, or if it gave you something to think about that you hadn't considered before, hit that subscribe button. I put out videos like this regularly, breaking down the financial topics that actually matter for building long-term wealth. And if you know someone who's been stressed about what's coming in markets this year, share this video with them. Sometimes the most helpful thing you can do is help someone realize that uncertainty is normal and that not having all the answers doesn't mean you can't still make good decisions. I'll see you in the next one.